Hello and welcome. Today, we are going to learn about non-banking, financial companies. NBFCs in short. India's financial sector is huge. It comprises of commercial banks and NBFCs. NBFCs offer various banking services without banking license, such as loans and credit facilities, retirement planning, money markets, underwriting, and merger activities. NBFCs may be small, but they are important. This is true especially because at least 70% of the population in India lives in rural areas. NBFCs are not subject to the banking regulations and oversight by government authorities. So, what are the various NBFCs? NBFCs can be investment banks, mortgage lenders, money market funds, insurance companies, hedge funds, private equity funds, and P2P lenders. In 1965, the Chapter 3B was introduced to bring NBFCs under RBI. This was before the financing business was covered under Companies Act. A separate regulatory framework was introduced. In 1991, the Indian economy witnessed liberalization, privatization, and globalization. In 1992, measures for the effective regulation of the industry were suggested, which ranged from compulsory registration to prudential norms. In 1997, the RBI Amendment Act made it compulsory for NBFCs to start operations. During the Great Recession from 2007 to 2009, the credit demands were unmet by traditional banks. This led to proliferation and a rapid and gigantic growth of NBFCs. They have grown significantly over the last decade with a total asset size of more than $370 billion in India, which means they provided up to 20% of all credit in India until March 2018. Not only that, the NBFCs contributed to at least 22% of lending every year, on an average. Interestingly, NBFCs are more profitable than the traditional banks. That is because NBFCs have lower costs and cheaper loans. In fact, the amount of money that the NBFCs lend is higher than the banking sector. Surprising, isn't it? NBFCs also contribute largely to the economy by lending to infrastructure projects, which require large amount of funds. They earn profits only over a longer time frame. NBFCs promote inclusive growth by catering to customers in both urban and rural areas. They finance projects of small-scale companies, and provide small-ticket loans for affordable housing projects. In the future, NBFCs will continue to experience robust growth with minimal instances of delinquencies. That is if the credit flow does not stop, and the risk mitigation mechanisms improve.